It's been about 17 years since Alphabet Inc., the parent company of Google, went public. Now the question is, where does the performance of Alphabet Inc. over that 17 years horizon rank relative to blue chip companies such as Amazon, Microsoft, Oracle, and Cisco? In today's video, I will do a comparative analysis with the intention of providing an update to my initial valuation of the company. For those of you not familiar with my work, welcome to The Analyst. On the 19th of August 2004, Google went public at the offering price of $85 per share. The company will close that year trading at around $200 per share. So it's been about 17 good years. And the question is, what have we learned regarding the company performance and how can we use it to project ourselves into the future? In today's video, I will do a comparative analysis using blue chip companies such as Amazon, Oracle, Cisco, and Microsoft. I will try to justify my initial assessment of the company fundamentals, which was already pointing to an undervaluation. When we invest to make a return on our position. For an equity investor, the return comes in the form of the price appreciation of our position and in the form of dividend. So I will use two metrics that I believe to be very important in assessing the company capability to remain profitable into the future. The first metric that I'm about to present is the trend growth in earnings per share, which tells about the company's ability to make profit, but also tells about the operational efficiency at the company level. And the second metric that I'm about to use is the sales growth, or the trend growth in sales over the 17-year horizon, has an indicator of the company ability not only to keep existing customer but to grow market shares into the future. So here is the first graph. For this exercise, I will introduce two charts. The first is the trend growth of sales over 18 years period. It tells us about the rate at which each company grew 1 unit of sales over our horizon. And as we can see, the top performer was Cisco with the trend growth of sales at about 47%, with the worst performer being Alphabet with the trend growth of sales at about 33%. It is important to state, however, that higher sales growth does not always translate into higher profitability. So comes the second chart, which represents the trend growth of IPS over 18 years horizon, or which represent the rate at which each company grew 1 unit of IPS over 18 years. And as we can see again, the top performer was Cisco with the trend growth rate of IPS at about 51%, followed by Oracle with the third top performer being Alphabet with the trend growth rate at about 43.3%. So how those financial market participants price the performance of each company considering what they knew about the company or considering the expectations? Over the 80 years horizon, again, the top performer was Cisco, justified by the fundamentals, with the price topping $8,000, followed by Microsoft, with the with the third performer being Alphabet Inc. What does that level of price represent in comparison to the beginning price, or to the price at the beginning of the investment period? It represents, for the top performer, a price increase of about 324x for Cisco, 259x for Microsoft, and the worst performer in terms of price being Alphabet Inc. with the price at about, with the multiplier at about 28x. So considering the profitability metric that we presented, which is the trend growth rate of IPS over the 18 years investment horizon, Alphabet Inc. or Google was the third best performer. So the question is, how did the company end up being the worst performer in terms of price appreciation over the 18-year investment horizon? And I will try to explain that by introducing the next and last chart, which represent the stock split history for each company. The number presented in the chart represent the number of stock that was given to each holder of IPO stock. And as we can see, Oracle is the company that issued more by giving 324 stock for each holder of IPO stock, followed by Microsoft and Cisco, with Alphabet being at the bottom with two classes of stock that were issued around 2014, if I got the date right, for each unit of IPO stock. So taking all these into consideration, I believe that the price underperformance of Alphabet Inc. is the result of the company's failure to understand that a stock split, when a company is doing well or when the economic environment is good, stimulate the demand side more than the supply side, exerting a pressure which increase the price of a given company stock. So having said all of that, I believe the company is still significantly undervalued and should be trading at around $4,215. This is obviously gonna depend on the company ability to remain profitable, dominant in its industry, and depending upon how the company is going to evolve in the future. We know that there are many projects going on, especially the autonomous car project. So I am pretty confident that this company will make it happen. This is a solid company. I am also confident that the company in the near term will probably execute a stock split. I believe the company will return to its fair market value within the next 4 to 5 years. So I hope you like this, and if you did, do not forget to subscribe. Important to mention that I am not a financial advisor. A financial advisor is the one that is more qualified to provide an investment advice which is suitable to your psychological and situational profile. See you next time.